Imagine this. You're sitting at your dining table, calculator open, mortgage pre-approval letter in hand, and everyone around you is celebrating. Your parents are proud, your friends are jealous, your Instagram story gets 47 likes. You just got approved for a $350,000 starter home. But here's what nobody told you. You didn't just buy a house, you bought a subscription to staying broke for the next decade.
Ah! Get off me, you constrictor! It's tightening my subscriptions! I can't escape!
And the math is so brutal, it's almost beautiful. Let me show you the numbers they don't put in the glossy brochures.
50,000? I can't pay that! Ugh, it's hopeless!
That $350,000 home? With a 20% down payment, you just locked $70,000 into an illiquid box. Your monthly payment is $2,200. But here's where it gets surgical. In year one, only about $600 of that goes to principal. The rest? Interest, taxes, insurance, and PMI if you didn't hit 20%.
You can't escape me! Pay up!
Ah! No! Get away from me!
I am your debt! You will pay!
You're paying $1,600 a month to rent money from a bank while your equity builds at the speed of continental drift. Your $70,000 is now stuck in drywall, generating zero cash flow, zero dividends, and zero optionality. The math doesn't have an ego. It just sits there, compounding against you while you mow the lawn. But here's what makes this a trap instead of just a bad deal. You now have a baseline expense that scales with your lifestyle, not your freedom. That $2,200 monthly nut becomes the floor of your existence. Every other decision you make, career, relationships, risk tolerance, now has to clear that hurdle. You can't take the lower-paying job that might teach you a skill. You can't move cities for an opportunity. You can't weather a layoff without sweating. Your promotion isn't to win anymore. It's just your new salary catching up to the bills you already committed to. Your promotion is a trap if your bills invited it to stay.
Hey, wait up!
Darn chain!
Now, before you think I'm anti-homeownership, let me be clear. I'm anti-math illiteracy. A house can be an incredible asset, but a starter home specifically is a financial algorithm designed to keep you running in place. And the people who escape the 9-to-5 don't run in place. They run the math, find the glitch, and exploit it until they're invisible millionaires. Let's debug this system. The villain here isn't homeownership. It's linear thinking in a non-linear world. Society sold you a script: save for a down payment, buy the starter home, upgrade in 7 years, repeat until you're 65 and finally own something. That's a 40-year treadmill, and the whole time you're playing a game where your effort scales 1-to-1 with your output. Work harder, earn more, spend more, repeat. If the math is linear, the exit is a fantasy. But there's a different game. It's called nonlinear math, and it's the only reason anyone retires early. Nonlinear math is when your money works harder than you do. It's when $10,000 invested today turns into $50,000 in 10 years without you lifting a finger. It's when your assets generate cash flow that covers your expenses and your time becomes yours again. The math doesn't care about your work ethic. It cares about the structure you built. And a starter home? That's the wrong structure. Let me show you the throughput problem. Think of your financial life like a server handling requests. Every dollar you earn is a request. Every expense is a process that consumes resources. A starter home is a massive, always-running process that eats 30 to 40% of your monthly throughput. It doesn't generate output, it just consumes. Meanwhile, your other processes, investing, skill development, optionality, are starved for resources. Your server is maxed out and you're wondering why you feel stuck. Compounding is quiet, quicksand is loud, and right now you're drowning in the noise of a payment you can't escape.
No, no, no! Not again! Get off my couch, Dad! This is a nightmare!
Here's the alternative structure. Instead of the starter home, you rent strategically and deploy that $70,000 into income-generating assets. Let's stress test this with brutal math. Take that $70,000 and split it. $50,000 into a diversified index fund averaging 10% annually, $20,000 into a high-yield savings account as your liquidity buffer. In year 1, your index fund generates $5,000 in gains. Your savings account generates $1,000 in interest at 5%. Total passive income, $6,000. That's $500 a month you didn't work for. Now, compare that to the starter home. In year 1, your equity build is about $7,200. Looks better, right? But here's the glitch. That equity is locked. You can't spend it, you can't move it, you can't access it without selling the house or taking out a HELOC, which just means more debt. Your $7,200 is trapped in drywall, while your $6,000 from investments is liquid, movable, and deployable. Wealth is the optionality you didn't spend. The starter home spent your optionality on a fixed asset that doesn't pay you. But let's go deeper. Let's run this out 10 years and describe the divergence. If you look at this XY axis, you'll see the curve doesn't just move up, it teleports. On the left axis, we have net worth. On the bottom, we have time. The blue line is the starter home buyer. The red line is the strategic renter who invested instead. Year 1, blue line is at $76,200, your down payment plus $7,200 in equity. Red line is at $76,000, your $70,000 investment plus $6,000 in returns. They're basically tied. But watch what happens at year 5. Blue line is at $106,000. You've paid down $36,000 in principal, but your home only appreciated 3% annually, adding $56,000 in value. Subtract the $70,000 you put in, and your net gain is $36,000. Not bad, but the red line is at $131,000. Your $70,000 compounded at 10% is now $113,000, plus 5 years of contributions from the money you saved by renting cheaper. The gap is $25,000, and it's widening.
Now let's hit year 10. Blue line is at $150,000. You've paid down $72,000 in principal. Your home appreciated to $470,000, but you still owe $278,000. Your net equity is $192,000. Subtract your initial $70,000, and your gain is $122,000. Solid. But the red line is at $287,000. Your initial $70,000 is now $181,000. Your continued monthly investments of $1,000, the difference between your rent and what the mortgage would have been, compounded to another $106,000. Total gain, $217,000. The red line just lapped the blue line, and the gap keeps growing exponentially because compounding doesn't plateau, it accelerates. Here's where the average person pushes back. They say, but rent is just throwing money away. At least with a mortgage, I'm building equity. Let me debunk this with the math they don't want you to run. In year 1 of your mortgage, you paid $26,400 total. Only $7,200 went to equity. The other $19,200 went to interest, taxes, and insurance. That $19,200 is thrown away. It's gone. You didn't build equity with it. You rented money from a bank. Meanwhile, the strategic renter paid $1,500 a month, or $18,000 annually. They threw away $18,000 in rent, but they also saved $8,400 by not paying the extra $700 a month the mortgage would have cost. That $8,400 got invested and is now compounding. The math is brutal, but the freedom is better. Let me give you the identity shift required to see this clearly. You are not a homeowner or a renter. You are a system administrator of your capital. Your job is to allocate resources to the processes that generate the highest throughput with the lowest latency. A starter home is high latency, low throughput. It takes years to access your equity, and the returns are mediocre compared to liquid investments. Strategic renting is low latency, high throughput. You keep your capital liquid, deploy it into assets that compound, and maintain the optionality to move, pivot, or scale when opportunities arise. But here's the psychological trap that keeps people buying starter homes anyway: status. A house is visible. It's a signal. You can post it on Instagram. You can invite people over. You can say, "I'm a homeowner." But here's the truth that separates the invisible millionaires from the Instagram millionaires: assets greater than accolades. The person with $300,000 in index funds and a rented apartment is wealthier than the person with $150,000 in home equity and a car payment. But the latter looks richer. And if you're optimizing for looking rich, you'll stay broke. Solve for freedom, not for status. Let me show you the server load comparison. Imagine your financial life as a server farm. Every financial commitment is a server running 24/7. The starter home is a massive server running at 40% CPU utilization, constantly consuming energy, requiring maintenance, and producing minimal output. Your investments are lightweight microservices running at 5% CPU each, generating passive income and scaling effortlessly. Which architecture would you choose if you were designing a system for efficiency? The answer is obvious, but people choose the starter home because society taught them to optimize for the wrong metric: ownership
Yes, my
instead of
portfolio is up
optionality.
25% year to date.
Now let's talk about
Time
the
for a victory slice.
15-65-20 rule. This is the framework the invisible millionaires use to structure their financial lives. 15% of your income goes to fixed necessities: rent, utilities, groceries. 65% goes to investments and assets that compound. 20% goes to quality of life and skill development. Notice what's missing: car payments, starter homes, status purchases. If your fixed expenses exceed 15%, you're running the wrong operating system. And a $2,200 mortgage on a $6,000 monthly income is 37%. You're underwater before you even start investing. The average person thinks the 15-65-20 rule is impossible. They say, "How can I live on 15% for necessities? That's insane." Here's the brutal math that proves them wrong. Rent a modest one-bedroom for $1,200 in a lower cost of living area. Utilities and groceries, $300. Total is $1,500. That's 15% of a $120,000 salary, which is attainable for mid-career professionals in tech, finance, or skilled trades. But instead, people buy the starter home in the expensive city, lock themselves in to $2,200 a month, and then wonder why they can't invest. The math doesn't lie, your choices do. Here's the milestone mathematics for escaping the starter home trap. First milestone, $25,000 in liquid investments. This is your freedom floor. At 10% annual returns, this generates $2,500 in passive income. It's not life-changing yet, but it's proof the system works. The identity shift here is you are no longer broke. You're a capital allocator in training. Second milestone is $100,000 in liquid investments. This is the tipping point. At $100,000, your money starts compounding faster than you can save it. Your annual return at 10% is $10,000. That's $833 a month you didn't work for. The identity is you are no longer trading time for money. You are managing a machine that prints cash flow. Third milestone is $250,000 in liquid investments. This is the invisibility threshold. At this level, your annual returns are $25,000 or $2,083 a month. If you've kept your expenses at 15% of income, you're now covering 30 to 40% of your lifestyle with passive income. The identity is you are no longer an employee. You are an investor who happens to have a job. Fourth milestone is $500,000 in liquid investments. This is financial independence. At 10% returns, you're generating $50,000 a year. If your annual expenses are $36,000, 15% of a $240,000 lifestyle, scaled conservatively, you're now free. You can work if you want, you can quit if you want. The math has given you optionality, and optionality is freedom.
But here's where the math gets weird. The jump from $250,000 to $500,000 happens faster than the jump from $0 to $100,000. Why? Because compounding is non-linear. At $250,000, your annual returns are $25,000. If you're still contributing $30,000 per year from your salary, you're adding $55,000 per year to your portfolio. It takes you about 4 years to double to $500,000. But getting from $0 to $100,000 takes 7 to 8 years of grinding contributions because your compounding engine is still small. This is why the first $100,000 is the hardest. After that, the math starts working for you instead of against you. Nonlinear math greater than linear effort. The people who figure this out in their 20s retire in their 30s. The people who don't figure it out until their 40s retire at 65. The difference is just understanding the algorithm. Now, the counter-argument, but what if I want to start a family? Don't I need a house for that? Let me stress test this with data. The average American family spends $2,200 a month on housing. The strategic renter spends $1,500 per month and invests the $700 difference. Over 18 years, the time it takes to raise a kid, that $700 a month compounded at 10% turns into $329,000. That's a college fund, a down payment on a forever home, or a decade of financial independence. The starter home buyer spent the same $700 on interest and taxes and has zero to show for it. The math is surgical. You can raise a family in a rented 3-bedroom and still retire early, or you can buy the starter home and work until you're 65. The choice is yours, but the math doesn't change. Let me give you the final identity shift. You are not a homeowner, a renter, a saver, or a spender. You are an architect of optionality.
Welcome to the Optionality Empire. Another empire? With full scalability and synergy. And more paperwork.
Every financial decision you make is either expanding your optionality or shrinking it. The starter home shrinks it. The car payment shrinks it. The luxury apartment in the expensive city shrinks it. But the strategic rent, the index fund contributions, the refusal to inflate your lifestyle, these expand it. And optionality compounds faster than money, because once you have optionality, you can take the risks that lead to exponential returns. You can start the business. You can negotiate from a position of strength. You can walk away from the toxic job. Wealth is the optionality you didn't spend. Here's the bridge. If you're sitting here thinking, okay, I see the math, but how do I actually implement this? How do I know if I'm on track? You need a system. Not a budget, not a spreadsheet you'll abandon in 3 weeks, a system. That's why I built the Wealth System Dashboard. It's a calculator that takes your current income, expenses, and investment rate and shows you exactly when you'll hit each milestone. $25,000, $100,000, $250,000, $500,000. It shows you the power of the 15/65/20 rule in real time, and it stress tests your decisions. Should you buy the starter home or invest? Plug in the numbers and the dashboard shows you the 10-year divergence. Should you take the promotion with the longer commute? The dashboard calculates the time cost and shows you if it's worth it. The math doesn't have an ego, but it does have an answer, and the dashboard gives it to you in seconds. Here's the brutal truth. Most people will watch this video, nod along, and then buy the starter home anyway, because the social pressure is too strong, because their parents expect it, because they think optionality is a luxury for rich people. But optionality isn't a luxury. It's the only rational goal.
Whoa, look at all these temptations swirling around. But I'll save this coin for a rainy day.
And the invisible millionaires know this. They're the ones renting the modest apartment, driving the paid-off Toyota, investing 65% of their income and retiring at 38. They're invisible because they refuse to buy the status symbols that make you visible. And they're millionaires because they let the math do the heavy lifting. A car payment is just a subscription to staying average. The starter home is just a longer subscription with a prettier box. And if you keep subscribing to averageness, you'll get average results. But if you cancel the subscriptions, redirect the capital, and let compounding do its thing, you'll hit financial independence while your peers are still arguing about interest rates. The math is brutal, but the freedom is better. So here's your action plan.
Yes, the numbers are climbing. We're making a fortune. This is incredible!
First, run the numbers. Calculate your current savings rate.
Calculate what the starter home would cost versus renting strategically and investing the difference. Use the wealth system dashboard if you want the answer in seconds instead of hours. Second, make the identity shift. Stop thinking of yourself as a future homeowner. Start thinking of yourself as a system administrator of capital. Third, commit to the 15/65/20 rule for 1 year, just 1 year. Track the results. Watch your net worth grow faster than it ever has. And fourth, ignore the noise. Your friends will buy houses, your parents will ask when you're settling down, your Instagram feed will be full of housewarming parties. Let them. You're playing a different game. Solve for freedom, not for status. If this system made sense to you, hit the like button so the algorithm knows to show this to more professionals who need an exit strategy. And if you're ready to stop building a lifestyle you have to defend, subscribe and join the ranks of the invisible millionaires. Understanding why the starter home is a trap is half the battle. If you finally see why the math is brutal, you aren't ready for what happens when you start optimizing for time instead of money. Click the video on your screen right now to see how the invisible millionaires buy back their hours, and let's keep turning your money into freedom instead of stress.